So in my hand here is the framework that we use to evaluate billion-dollar startup ideas. Angel round, pre-seed, seed, terms like Series A, Series B, etc. They get thrown around a lot in the venture industry, in the startup scene, and even if you're new to the startup world, this is quite intuitive and you think, well, there's probably a progression here, and that's definitely the case. But once you start talking to founders and witnessing a couple of fundraisers, capital raises, you realize that it's not as clear-cut as it seems. In this video, I will take you through the thinking that we do as an investor, and I will share the framework with you that we've come up with to categorize our startup leads. Hi, I'm Johannes and I recently joined IceCube Ventures, an investment firm based in Switzerland that invests in early stage technology companies, especially in the deep tech, med tech and healthcare sector. Before we get into the framework that we use to categorize our leads and get some structure into our deal flow, I'd like to say a few words about how we approach the idea of working with startups in general. As investors, as capital allocators, it is our duty to put the founders on a pedestal, because it's the founders that are down there doing the work and every day putting in blood, sweat and tears to make their ideas come true. So there is tremendous respect from our side into what founders do every day. And we know this because we have an entrepreneurial background ourselves. We don't want to talk about that too much because you can't compare anything. Like, everyone is on their own journey. A founder dealing with day-to-day issues every day doesn't care about that. So we want to make sure that we help the founders where they need the help the most. And when I get involved in a business, I make it my number one priority to try and help the founder reach their goals as quickly as possible, no matter if I have a stake in the business or I'm just looking to invest. It's really a matter of thinking, where can I add the most value? And then we can always look at what will develop from this relationship, because it's relationship building that is so important at the start, and it's really respecting the founders, respecting their time and listening more than you talk. In fact, I actually make it a competition almost to be the investor that contributes the most. So obviously this is easier when the company is small because my influence is only so big, but it's just for myself. When I get up in the morning, I ask myself, how can I make the most impact and build the most value for this particular founder that I'm currently speaking to. So on a day-to-day basis, we get a huge number of startup leads into our pipeline, and then it's a matter of categorizing these leads into the correct buckets so that we know what to do with them. And we found it quite difficult to work with these terms that I mentioned at the start, like seed, pre-seed, series A, B, C, etc., because every startup's journey is a little bit different. Not necessarily every startup is going through the same levels of funding, the same journey of funding. So what we try to do is we try to categorize it according to the actual stage the company is in. So we've come up with a framework that has 4 phases, and that's just a framework that works for us, categorizing and bucketing our leads into the correct phase. So phase number 1 is when there is really only an idea out there. Maybe the founder or 1 or 2 founders have already thought about and developed an MVP, but usually they're at the very beginning. Maybe they have an MVP ready, so MVP is minimal viable product, and they can be incorporated or not. This phase 1 is really exciting because that's when an idea comes to life for the first time, and you can already identify which direction is it going, and especially you focus most on the founder and on the idea as a concept, but there's not really much there to work with. Phase 2 of a startup's life, so when it's survived phase 1 and you're going to the next level, that's when you're definitely incorporated. There is an MVP there, it's alpha and beta testing. There is a small team and they have a small payroll that they're starting to roll out structures and have some sort of a company there. In healthcare, this is at the preclinical stage, but let me know in the comments if you want to hear more about healthcare startups. That's actually a little bit different of a challenge because healthcare startups need a lot more liquidity before they get to a significant level of success. Moving on to phase number 3. So you've survived the first 2 phases with the startup, and now you are actually making your first revenue. That's a very exciting moment in the startup's life when first money is coming in. And that comes with the first clients as well. Usually this is also a time when we start speaking about ARR, which stands for annual recurring revenue. This is an important metric because if you have only 2 months of traction and you're already making money with the clients, you then calculate and extrapolate from that how much that would be per year, even though you only have maybe 1 or 2 or 3 months. We're in the growth stage here, and it's really all hands on deck as it evolves from a mere idea and a mere one office company into bigger headcount and bringing in more structure. Phase 4 is the last phase that we cover in this early stage investment framework. And that's when we see startups getting traction, getting recognized, and building a brand for themselves and moving from this startup phase into more of a scale-up phase. At that point, they are thinking about expanding into new markets, new countries, and possibly also thinking about acquisitions, how they can acquire a competitor, bring that in and complement their product offering. All right, so now that we have these phases figured out, I wanted to talk about the different equity considerations at the different points in time. So let's go back to phase 1. So at that moment as a founder, it's most important, in my opinion, to just keep bootstrapping the startup and take as little money in as possible, because you gotta protect your equity when you're building that up. You're putting blood, sweat, and tears into the company and building up the equity. And the longer you can bootstrap, better you will be off at a later stage. Phase 2, when you've made it over the bump, you've sort of proven yourself for the first time. That's when we're speaking about 500,000 to maybe $5 million valuation. And that really depends on how much tangible stuff is there for the startup to really be worth something. And that's why it comes down to, in phase 1, bootstrapping as much as you can so that you can have something to show for when the valuation is on the table. In phase 3, we are typically seeing valuations of 2 million to maybe 10 million. And that also really depends on where the company is at. And again, caveat here, healthcare is something different. If you want me to dig deeper there, leave me a comment below. In phase 4, sometimes earlier, sometimes later, you get faced with the fork in the road. Do you keep scaling on your own, or do you think about exits and IPOs? Now again here, we've gone now from phase 1 to phase 4, and still the equity that was generated at the very beginning can be crucial, and it will determine whether you go one way or the other, because it's a matter of control. So often founders and investors have different viewpoints, and if there's enough cash, then it's an easy decision to keep scaling. At some point, investors will want their money back, so at some point there will be an exit or an IPO if it's really investor driven, whereas if it's mostly founder driven, it can just remain private and you can keep scaling with the cash flow that you're generating yourself. Having made these equity considerations, I now want to go into what kinds of investors are applicable at each phase of the company. So in phase 1, we often see angel investors, friends, family, and fools, as they are lovingly referred to. That's really when the founder needs to leverage their network, their friends, their own savings, and really pour everything, bootstrap the company in a way that gets it to the next phase. Actually, there are a few private investment clubs that also go in at that stage. That is a really exciting time to go in. And for example, there's a company in Switzerland in our ecosystem called Spitzhorli, and they invest at that stage. And that's very exciting because there's really not much to go off. And so the company has 20 minutes to pitch, 20 minutes discussion, and then 20,000 Swiss francs of investment at the end if it's successful. This is really a way to get in at the ground floor, and it's very exciting. Now I will wrap together phases 2 and 3 at this point, because this is where the early stage funds come in. And early stage funds like ourselves, we invest in phases 2 and 3 and really want to bring the companies from level 2 to 3 and 4, from level 3 to 4. And that's where our sweet spot lies in terms of the companies that we are looking for, the ideas and the founders, because we have seen the idea make sense. So we see a big idea and we see that matched with a great founder. That's the best combination for us. That's where we want to get in. We don't necessarily have big criteria like minimum ARR like some VC funds have. We are a lot more flexible. And that's why I'm wrapping that all together in phases 2 and 3. Phase 4 is for the more traditional venture capitalists who does have these criteria, fixed criteria of revenue, expectations, etc., etc. So that's usually not our sweet spot anymore. We like to hand over our companies at that point to a successful VC and see that the startup founders are in good hands with our partners from our network. So there you have it. This is the investment framework that we use in IceCube Ventures to evaluate the startups and see where they come into our portfolio and at what stage they are in, so that we can help them succeed, help them reach their goals, and get to the next phase and ultimately go to the moon. If you enjoyed this video, I have another video on how to invest in startups, which I'm going to link on the screen right now. Thank you for watching, and I'll see you in the next one.